Okay, so we're going to talk about the types of adjusting entries. There are two main categories of adjusting entries. There are deferrals and accruals. Okay, so deferrals are going to include prepaid expenses. So these are expenses that are paid in cash before they are used or consumed. So that would be like paying for your insurance for a full year. Or, so that'd be prepaid expenses or unearned revenues. So this is where we receive cash before services are performed. So this might be where a customer gives us $50,000 for services, and then we're going to provide the services over a period of time. So then what happens with both of those is that for the prepaid expense, as we use up the insurance, each month, we have to do an adjusting entry to recognize the amount of insurance we've used up and to reduce the prepaid expense, which is an asset. For the unearned revenues, we have to recognize the amount of revenue we've earned and reduce the unearned revenue, which is a liability. Now, for accruals, accrued revenues are revenues for services we've performed, but we have not yet received cash or recorded. So that you have already done. You did that already. That's where you provide services to a customer and they're going to pay you later. That's where you debit accounts receivable and you credit cap or you credit revenue. Accrued expenses are expenses incurred but not yet paid in cash or recorded. So that might be where you receive a utility bill, but you're going to pay it later, right? So you would debit utilities expense and then you would credit utilities payable. Okay. All right. So we are going to look at deferrals. Deferrals. All right. Now this is just showing us on the screen here what we've done so far. We've learned the analysis and journalizing, right? We did those together, right? We analyzed the transaction and journalized it. We posted it. We then did the trial balance, right? We did the trial balance part. And now we are doing the journalize and post AGEs or AJEs or adjusting entries. Okay. So these are good examples for you to write down. These are ones that you will likely see at some point down the line. So prepaid expenses, the types of prepaid expenses you may see: insurance, rent, supplies, equipment, advertising, buildings. Now, I will tell you this, the equipment, whoops, let's see, let me erase this. The equipment and the buildings, what those will have to do with is depreciation. So those are going to be a little bit different. And the supplies is going to be a little bit different, okay? The other ones that we see here, the insurance, the rent, and the advertising, those are all going to be prepaid. So they'll say like prepaid insurance, prepaid rent, prepaid advertising. The supplies is going to be different, and the equipment and the buildings are going to be different. So I will, we'll look at those individually when we get to those, okay? So prepaid expenses. So prepaid expenses expire either with the passage of time or through use. So like with supplies, we either use up the supplies and we have to do an adjusting entry to make our supply number correct, or we buy an insurance policy for the full year, and then each month we use up a portion of that insurance policy, all right? You will want to note this. The adjusting entry for prepaid expenses is to debit an expense account and credit an asset account, all right? So you're debiting the expense account that's linked to the prepaid expense, okay? So that might be where you debit insurance expense and you credit the asset account prepaid insurance. That might be an example of that, okay? And we're going to go through all of these. This is just, we'll do sample problems and stuff. This is just, you want to note this right here, that when you do the adjusting entry for prepaid expenses, which, a reminder, prepaid expenses could be any of these here: insurance, supplies, advertising, rent, equipment, and buildings. You're going to debit an expense and credit an asset, okay? All right. So here's an example. January 1, you pay $1,200 for a 1-year insurance policy. What is the entry? What is the entry when the bill is paid? Okay, so when the bill is paid, we should have a thing here. When the bill is paid, your entry is to debit insurance, or debit prepaid insurance, right? Because you're buying the insurance for a full year, and you're going to credit cash because you paid cash for it, okay? What is the adjusting entry each month? What you would do is you would take the total amount of the insurance, and this is $1,200. You would divide it by the number of months in the year, which is 12, right? So we've got $1,200 divided by 12 months. That means that the insurance expires or is used up at $100 per month. So every month, at the end of the month, you're going to debit insurance expense $100, and you're going to credit prepaid insurance $100. Now, when I worked in accounting, the way this would work is that at the beginning of the year, when I paid this $1,200 bill, I would make 12 copies of that bill. And I had a set of file folders, and I had a master file, and then I had one that had one for January, February, March, April, May, June, July, one for every month of the year. And if I got something like this, what I would do is I would handwrite on there. I would say, 1-year policy, $1,200 divided by 12 months equals $100 per month adjusting entry. And I would put a copy of that in every month of the year, okay? So then at the end of the month, when I was ready to close the books, I would pull out the file, January, if it's the end of January, and in there would be all the adjusting entries I'd have to do for the month. Then I would put the main one, the master, in the master file. At the end of the year, I would go through the master file and I would go, oh, here's an insurance policy that was for the year of 2022. It was for 12 months, so it's for the full year. So I can go ahead and I can throw that one away. But I might have something in that file that's over 1 year. It might be like a 6-year insurance policy. So I would look at it and I would go, oh, okay, I did 2022, so I can cross that year off. Now I need to make copies for every month of the year for 2023. And I would do that every year for the 6 years until that entire account was used up. That's just kind of an example so you know what would really happen. This is showing us kind of a different example here. Now, supplies are different, and you need to make a very important note here about this. When you are dealing with any of the questions that have to do with supplies, the number that you want is what was used. The number you want is what was used, okay? So you're always trying to find what was used. No matter what the problem tells you, you want the number that's used. Sometimes they tell you what was used. Sometimes they give you other numbers and you have to figure out what was used, okay? So here's an example of that. Sierra Corporation purchased supplies costing $2,500 on October 5th. And so supplies are things that you use up in your business that you don't necessarily, like, you don't make it and give it to your customers. So supplies for Los Madonnas for a teacher might be like the pens we use to write on the board or the copy paper we use up. Those are supplies, okay. Sierra recorded the purchase by increasing or debiting the asset supplies. This account shows a balance of $2,500 in the October 31st trial balance. An inventory count at the close of business on October 31st reveals that $1,000 of supplies are still on hand. So remember, the number we want is what was used. What was used. So what they're telling us is that we started with $2,500, right? Because the balance in the trial balance was $2,500. But when we went out and counted it, we only had $1,000. So that means we started with 2,500. We have 1,000 left. So if we subtract what we started with from what we have, that's going to give us what we used. Okay. We started with 25. We have 1,000 left. That gives us what we use, which is $1,500. So now that $1,500 is no longer an asset sitting on the shelf. We've used it up. So now it's become an expense. So the entry for the supplies is going to be debit supplies expense for the amount that you used, and credit the asset supplies for the same amount. Okay, so you will want to know this entry because this is one that you will see again. The key piece for supplies, we're always looking for what we used. Okay, let's see. So here's another example. On October 4th, Sierra Corporation paid $600 for a 1-year fire insurance policy. Coverage began on October 1. Sierra recorded the payment by increasing or debiting prepaid insurance. So that means that when they bought the insurance policy, they debited prepaid insurance $600 and they credited cash $600. Okay. The prepaid insurance, or this account, shows a balance of $600 on October 31st. So now what you need to do is you need to figure out, well, how much did you use up of the prepaid insurance? So they've done it here for you, showing you that insurance of $50 expires each month. And the way they got that is that the total policy was $600 and they divided it by 12 months. And so the amount that's used every month is $50. So every month they're going to debit insurance expense, $50, and they're going to credit prepaid insurance, $50. So this is another type of entry that you're going to see that has to do with prepaid insurance, okay? So with the prepaid insurance, you're looking for the total that they paid for it and the number of months that it's good for. So it could have said that you paid $600 for a 2-year policy. If it said that, it would be $600 divided by 24, not 12. So you really have to watch real close the information that they're giving you in the problem, okay? And all of these entries are in your book. So you can go back and look at all these entries too in your book, okay? And we're gonna do some samples, okay? So it's insurance expense because we've used it up. We've used it up. So an example of this might be that, let's say you have Geico insurance, right? And it's $600 a year for your, or no, it's $700 a year for your insurance policy. But if you pay the full year at once, you only have to pay $600. So you save $100. So you would pay $600, and when you pay that $600, you debit the asset, prepaid insurance, and you credit cash. And the reason why it's an asset, prepaid insurance, is let's say it's December 30th and you pay the insurance for the next year. It's an asset because if you decide on January 1 that you're going to cancel that Geico policy, you're going to get that money back. It's an asset. You're going to get that money back. Now, we're not talking about return fees or anything like that, okay? So it sits in there as a prepaid insurance, as an asset, until we use it up. So every month when we use it up, now the month of January is passed, we've used up $50 of that insurance. So we've used up $50 of it. And that means if we look down here on the bottom in this prepaid insurance T account, we have, at the end of October, we have $550 left to use up. And then every month it's going to go down. At the end of November, it's going to be, we have $500 left. At the end of December, it's going to be, we have $450 left. And it's going to keep going down, 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 down until it gets to zero. And the insurance expense is going to keep going up, 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 up until it gets to 600. So it's like you're moving it from one account to another is what you're doing with this, okay? And again, we're going to do some samples. This is just more like the lecture information part. Okay, so the other adjusting entry that we have is for depreciation, and this is for plant assets. So these are for buildings, equipment, motor vehicles, the kinds of things that you're going to see mostly as equipment. You will see buildings at some point, but it's mostly going to be equipment. Now we have an entire chapter on depreciation because it's a big process. for figuring out depreciation and getting rid of assets and all that. So we have a whole chapter on that. So in this chapter, don't worry about how they're getting to the numbers as much as what numbers you need and what the process is to do it, kind of thing. So depreciation, what happens is when you buy what they call a long-lived asset, which means that this asset is going to help you to produce revenue over a long period of time, you're going to take the cost of that revenue and you're going to distribute it over the revenue producing life of the asset. So instead of buying a truck worth $12,000 today, let's say you bought a truck worth $12,000 today and it was going to run for 1 year. It was going to be your delivery truck for 1 year only. So you would not debit equipment and credit cash. I mean, you wouldn't debit an expense and credit cash. You would debit equipment and you would credit cash. Then what would happen is every month you would do an entry to recognize how much of the revenue producing life of that asset was used up. So we said it was a $12,000 truck and it was going to be good for 1 year. We would take $12,000 divided by 12. That means that we would use up $1,000 a month. So every month we would debit an account called depreciation expense and we would credit an account called accumulated depreciation equipment. And if you think back to chapters 1 and 2, to the financial statements, especially 2, if we remember, we see, like, it would say equipment $12,000, then right below it, it would say less accumulated depreciation, and then it would show the book value of the equipment as $11,000 at the end of the first month, right? Now that's because the historical cost principle says that we always list the asset at the value in which we paid for it. So the equipment number will stay at $12,000 until we actually get rid of that asset. And the accumulated depreciation will continue to go up and up and up and up and up until it shows equipment $12,000, accumulated depreciation $12,000. So now we have $12,000 minus $12,000. Then it's zero. So the revenue producing ability of that asset is zero. That would be what was left. But again, we have a whole chapter on that, so we're not going to get too much into that. But here's an important thing for you to remember about the depreciation. Every single time you do an entry for depreciation, it is going to be a debit to depreciation expense and then a credit to accumulated depreciation hyphen, and then whatever the asset is they're talking about. So for instance, this one says, for Sierra Corporation, assume the depreciation on the office equipment is $480 a year or $40 a month. So every month, they're going to debit depreciation expense $40, and they're going to credit accumulated depreciation equipment $40. And why is it equipment? Because they told you in the problem here, it's equipment. Now, if this said building, then you would do accumulated depreciation hyphen building, okay? And right now, the majority of what you see is going to be equipment. You might see building, but I think the majority is going to be equipment. But this would be the type of entry you would do every single time, okay? Accumulated depreciation is what they call a contra asset. Contra means opposite. And so opposite, because an asset has a debit balance, right? A contra asset has a credit balance. So the contra asset subtracts from the asset account, okay? All right. And then this is just kind of showing an oversimplification of how it looks on the financial statements. You already did this in chapter 2, where it shows equipment, 5,000, and then less accumulated depreciation equipment, 40. So then the book value of this asset would be $49.60, the book value. That's not how much it's worth. That's the revenue producing ability that's left in that asset. And there's a whole process to figure that out, okay? All right, so this is an important slide for you to make note of. This is in the book. So go to the book and look this over, but you want to know what the examples are of prepaid expenses: insurance, supplies, advertising, rent, depreciation. I wouldn't worry so much about the reason. Don't worry about the reason. Don't worry about the accounts before and after. You can read that, but what you really need to know is what are the types, and then what do you do? What is your adjusting entry? You debit an expense, and you credit an asset or a contra asset. That's how you do the adjusting entry for these items. Okay.